private markets now. I'm joined by Erik Hirsch, co-CEO of Hamilton Lane. Erik, nice to have you on the program. So you are part of a leading global private markets investment management firm with about $1 trillion under management, and you say that you're very diversified. So obviously you have a very good insight into what we are seeing in these headlines right now, everything from cockroaches to red flags, investor exodus, and obviously some of the banks, even in this reporting season, have been addressing some of these worries. Can you just give us a perspective from where you sit on all of this?
Sam, great to be back with you. I think what I would say is we need some perspective. I think that's what's missing right now. I think you've got too much investor activity, particularly in the wealth sector, being driven by scary headlines and not being driven by good fundamental data. So if you look across the private markets, what do we see? Private credit portfolios, by and large, look strong. That's not to say everyone's portfolio is in perfect shape. They're not, but by and large, the sector in total looks very healthy and very strong. The venture sector right now is on fire. A tremendous amount of activity going on in the AI space, and venture is really fueling a lot of that. Infrastructure, we don't need to remind your audience about what the infrastructure needs are around this globe. What's happening in Iran right now, tragic as it is for those that are being negatively impacted, is really shining a light on the fact that a lot of countries need to domesticate energy sources, and that is going to get largely financed by the private market. So I look around today and I see a lot of green shoots, a lot of positive activity.
Okay, so can you just put it into context for us? Because obviously we continue to read these headlines, as I mentioned, and there have been some companies that have come out and actually explicitly reassured the markets about their software exposure, because obviously that's where we're seeing a lot of the concentration with the more sort of negative stories coming out. How big is private credit, and how much of that does it make up of that portion as to, where we're seeing the more sort of scary stuff happening and this talk of redemptions being capped, etc.?
Sure. So I think if you look at the private credit space, first of all, you're talking about hundreds and hundreds of funds that are operating around the globe. If you look at it over decades, you've had over 7,000 private credit funds in operation over the last several decades. The funds that are getting the attraction right now in the headlines are mostly evergreen and BDC. So these are funds that have a semi-liquid or liquid facility to them. And those, again, they're managed by a variety of managers who have taken a variety of different approaches to portfolio construction. So some of those portfolios much more kind of risk on, further out the spectrum on technology exposure, software exposure. Some of those portfolios very much risk off. And so right now I go back to the perspective word. The headlines are painting with this very broad brush that everyone's private credit portfolio looks the same. And I'm here to tell you, as the person who has the data, nothing could be further from the truth. One of the things you see in the private markets is that dispersion of performance across managers is very wide. It's wide today, it was wide 10 years ago, and it was wide 25 years ago. That isn't different. When you have a lot of different fund managers operating in a space, they're not all equally talented, and they don't all make equal decisions. And so investors should expect that you're going to see some dispersion. So part of this is on investors to make good choices as to who they're partnering with and who they're investing with. But private credit in total, well north of $1 trillion in assets, a portion of that is exposed to the software space. But a portion of that is also exposed to things like manufacturing or retail or rolling up businesses or industrial pieces. So those all carry very, very different risk profiles. And we have to go back to sort of, rather than the big broad brush, let's talk about managers and what they've actually done with their portfolio.
Okay, and I do want to talk about that, as to where the money is flowing right now. And I want to put it into context of the geopolitics, because obviously we are going through what feels like somewhat of a fundamental change about the way we're thinking about some of the infrastructure, how we're thinking about supply chains. And it kind of reminds you of how we thought about things post-COVID as well. I'm just wondering, obviously with this shifting landscape, the geopolitical fragmentation that you guys speak of in your market overview, the tariff tensions, the shifting goalposts as far as the repricing of oil and rates and growth expectations. Has that changed the way we should be thinking about investing in private markets too?
I think private markets have to be a core part of investors' portfolios. If it's not, then let's think about it from another perspective. What are we saying? We're saying then investors are essentially taking a path where their entire portfolio is made up of public securities. Well, the number of public companies is not growing. Globally, it's been shrinking, and it's been on a shrinking trajectory for a long time. Companies are able to stay private much, much longer. Infrastructure is something that is largely financed by the private space. The growth equity sector and growth capital, again, financed by the private space. So if investors want exposure to that, and if they want diversity and exposure to the broader part of the economy, they really need to embrace the privates, because the public markets have become dominated by a very, very small number of companies that tend to be very technologically oriented. They tend to be very, very, very big. But that's not what fuels our economies more broadly. They tend to be fueled by smaller, more local, more regional businesses. And again, I think what we see is investors are looking for diversification. And Marley said it earlier. People are also riding this constant roller coaster with the public markets. Today, everyone's euphoric. Tomorrow, everyone could be depressed. And then we're euphoric again, and then we're depressed. The private markets are just taking a much more measured, longer-term approach to capital allocation and investment decisions, and they're not rising and falling constantly by the current news or who sent a tweet or something, the tea leaves that I'm trying to parse through. They're trying to be much more fundamentally oriented. And right now, as a society, we have some fundamental problems that need solving. Energy is a huge problem. Roads, bridges, airports, big problem. How we're going to harness AI, so it's not just about the large language models, it's going to be about agentic AI and how we package that for consumers. That's going to get solved by the venture space. That's where those dollars are flowing now. So these are big problems. They're going to take time and patient capital, and that's exactly what the private markets are set up to deliver.
Yeah, and obviously it takes discipline, which is difficult for some investors as well to get their heads around. But you have said if you're not in venture, I mean, you are missing out on the compounding. Can you give us a sense of what that looks like versus the public markets?
Well, think about the public markets. Today, when we talk about AI and the public markets, we're really talking about chip producers and large language model producers. So that's what the public markets primarily are oriented around. But you can see it in your own life. Think about the number of use cases that if you look forward 6 months, 2 years, 5 years, that you're going to be seeing AI coming into your life, whether it's on your phone, whether it's on your watch, whether it's on your refrigerator. A lot of that is going to need innovation and development, and it's going to need capital. Those are going to be startup businesses that are going to be fueled by venture capital. Whether those companies ultimately ever go public, who knows, to be determined. A number of them won't, and certainly not all of them will succeed. But for investors who want to get in more at the ground floor, as opposed to 10 years from now, when those companies are already household names and then they go public, they're going to have to embrace the private markets. They're going to have to embrace venture capital and get in there early. So when we think about names today that investors are getting excited about IPOing, think about the private capital that's been in those companies for years and years and years. And think about the low valuations that they were getting exposed to that business at versus what the public market is about to get exposed at. A lot of gain going into the hands of the private investor, not the public investor.
Yeah, and a lot of AI companies staying private for longer. I mean, the ones we talk about every day, like Anthropic, OpenAI, I mean, they're not even public companies yet. So it's interesting as to sort of the impact that they do have on some of these public companies. Erik, fascinating chat. Thank you. Yeah,
Thank you,
great chat. I really appreciate you joining us today. Really, really great chat. Erik Hirsch there, co-CEO, Hamilton Lane.